This is Robert Kraft, and I'm your host on the Planet MicroCap Podcast. And with me today is the founder and CEO of Permanent Equity, Mr. Brent Beshore. Brent, it's an honor. Thank you for joining me today.
Hey, thanks for having me on.
It's great to have you. You know, I last saw you, really to prepare for this interview. I listened to pretty much all your interviews, the one that you did on Investing City with Ted Sides, of course, the 4 you've done with Patrick, and I just
My condolences.
well, I'm just really appreciative of you, taking the time here and doing this. And I saw you also do the interview with Morgan at the Microcap Club Leadership Summit. Shout out to Ian and Mike. And so it's a real pleasure, man. So thank you.
Well, thank you for having me on.
Cool. So I'm doing something a little different today. I haven't done this before in the 100 some odd interviews I've done prior. And that's, I want to set a goal and intention today because I know you're very busy and, again, you've done a number of interviews and I really want to set that intention for my audience. And really our whole goal today is that, I want to know how you've really uniquely positioned yourself to not only create a company like Permanent Equity and carving out this niche in private equity, and also, what investors who focus on investing in public markets can learn from your investing philosophy. So hopefully my questions kind of try and answer that. So really to start off here, as we get into it, is let's get your background. How'd you get your start and really get to where you're at today?
Yeah, it's a very odd, winding journey. So I started as an entrepreneur, founded a couple companies, and then accidentally bought a business as close to accidentally as you possibly can. So I did a private equity deal before I knew there's an industry called private equity. Never taken a finance class in my life. And that's really been kind of part of the DNA of who we are. So we're, sort of operator first. We're not financial engineers. And I think that goes to the ethos of kind of what makes us very different. Just compounded my own capital for the better part of 10 years and then raised a $50 million fund, a little over 2 years ago, and then just raised a second fund, a larger second fund that closed in December. So, we've got a portfolio of nine companies, really spans the geography of the United States as well as a lot of different industries. And the goal for us in the future is just pretty straightforward. We're going to keep doing more of what we're doing, buy companies with no intention of selling them, use very little debt in the process, and try to treat people really well and all profit together.
So where would you say that passion for business came from? As you said, you kind of accidentally bought this business, but you must have had some interest in business at some point.
Yeah, I grew up being interested in business, and I've always liked to play games. And business kind of feels like the hardest game, right? Most complex game in the world. And I was, like I said, I was an entrepreneur before I bought the first business, and was trying to make a go of it on that side. And like everything's hard, right? Starting a business is hard. Buying businesses is hard. It's just it's a matter of trying to figure out what niche you're going to try to carve out and what you think you can be the best in the world at.
Gotcha. So what then sparked that transition from, just being kind of a singular business owner to really this new age type of private equity firm that you have now?
Well, I wish I could say that it was a part of a grand plan or something. It just really evolved. It was very natural. So, after we bought the first business, I had already had a handful of businesses that had started. And so we were already kind of operating just by necessity as kind of a holdco. And then we added more companies, like I said, over the next, call it 7-8 years to that portfolio. And then at some point, we realized that we've got more demand for what we can do than we have supply of capital. And so didn't think we'd ever be able to raise and keep our kind of competitive advantages. And then met this incredible guy named Patrick O'Shaughnessy, who coerced me into taking outside capital, and kind of the rest is history.
I like coerced too.
Yeah. Well, I think he talked me into taking it probably 5 different times. In fact, I remember we were probably a month, maybe 6 weeks out from closing on the first fund, and I got cold feet, and he gave me a pep talk and got me back on the rails. So I was terrified of. We had a great thing going, and I was just terrified of how it would change us, and it turns into something that we didn't want to be.
Mm-hmm. So what did he say then that really helped you kind of take all right, we'll be okay?
I think you just said, get your head out of your ass and don't be an idiot. And, you've got a tremendous amount of people that believe in you, and it's going to be fine. And I think it was just an emotional state. I mean, it's hard when you've done certain things for a decade, and there was no oversight. There's sort of, it was just us doing our thing. And when you add SEC scrutiny into that, you add working for investors. I knew it would change us. I was terrified that it would change us in ways that were unproductive. And thank God it is not turned out to be the case that it's been a bad decision. I mean, it's been a wonderful decision. We couldn't be more pleased that we went down that path.
Gotcha. So, as you said, you started, so the previous name from Permanent Equity, your company used to be called Adventures, and it started back in 2007. What would you say was your thesis? Like, okay, we got all these businesses, or I have this one business, we have a couple others turning into a whole what was the thesis then for, all right, now we're going to be a company that buys businesses and holds them forever? What was that?
Yeah. Yeah, well, I think when you're young and you don't know, you want to taste and try a lot of different things. And so we tasted and tried more early stage creating companies, doing more early stage investments. And look, we did okay at those things as well. I mean, we incubated a successful company, made a couple of successful early stage investments through the years. And I think what we just realized is that's just not what we're the best in the world at. Like, that's just not what we have a shot at competing well. And, want to be located in Missouri, love Missouri, love Columbia where I live. And so it was, what can we do from here? Where would Columbia, what industries would Columbia be an advantage for as opposed to a disadvantage? And then I think, after the acquisition, that first acquisition went well, it really just led us into the direction that there were a lot of other companies that were out there that needed to transition. And they did really, the market, especially, 10 years ago, it was a very, very nascent small business acquisition market. I mean, there's more people doing it now, but back then, I mean, it was very few and far between. And so we really, we felt like we could be good at it. And we felt like there was very few people competing with us. And so, I mean, those are the, sort of marks of industry you want to get involved in.
Mm-hmm. So tell me a little bit about that creativity at the beginning, because I'm assuming, some of these businesses that I think I remember in some of your interviews, the first business you had was an events company. I mean, we run an event, so I know it can be, a lot of cash flow coming in. And, what kind of deals did you do in order to help your company grow then? Because I'm assuming it was probably still very difficult to just do all cash only deals, bring them in and just straight equity. How did you guys get creative at the beginning?
Yeah, so in the beginning, the first deal we did it was for a military recruitment firm called Media Cross. We still own it today, and thank God for the SBA. Used the Small Business Administration, got an SBA loan, and did real well with that. And obviously took those cash flows, paid off the loan, and rolled them forward. And then over time was able to build cash up and redeploy it.
Gotcha. So you recently actually made the name change from Adventures to Permanent Equity. I have to ask, why the change?
Yeah, well, so there's some basic rules around names. One is that people should be able to say it, and we had so the Adventures was with a dot in the name, which is our URL. So it was a hack domain. It's the shortest domain for that name, right? Which is very prestigious and smart, except if your target audience is, call it 55-year-old plus people. Who have no idea what the world your name looks like. And we got everything from Adventur.es. We had people asking us if we did business in the United States since we were headquartered in Spain. We'd get our emails would sometimes get rejected by servers because it was a foreign email. I mean, just all kinds of little. I would say that we did fine with the name. We loved the name, and the name served us well. It was a good B2B name. I would kind of say it that way. Our ambition is to become the go-to first stop for small business owners and the helpers of small business owners, as they look to exit their business. And I think that that's going to require a brand that was very different than Adventures and that had a sort of much more traditional connotations. And I think the defining thing about us that's so different than traditional private equity, we can go into the the details of how we're different. But the big thing is, I mean, we have 27-year lock capital with no off ramps and an option to renew year 25. So, I mean, we're functionally permanent capital. And I think that's the thing we've gotten really a name for. And the reason why sellers choose us over others is they don't want to be flipped. Right. I mean, traditional private equity structure really makes it difficult to hold something for longer than about 5 years.
Right.
And so even if you love the private equity guys that you're dealing with as a business owner, you know that they're going to sell it to somebody else in 5 years. And, you know, the thing you worked your entire lifetime. And a lot of these businesses will employ a big chunk of the community. Then the people they work with are like family to them. And so it makes it a very difficult dynamic. So I think that's one of the things that we really differentiated on. And that was, for us, a great way to change the name to. So permanent equity, permanentequity.com. Funny story about that, so Patrick, I kept using the term permanent equity. In fact, our funds were named Permanent Equity 1 and Permanent Equity 2. Right. So we already were using the name Permanent Equity. We just didn't have it, as the sort of headline name. And Patrick O'Shaughnessy ended up buying the permanentequity.com domain name after he met with me 4 years ago. And anyway, he graciously donated that to the cause as we decided to change our name.
Well, I have to ask, I mean, was there like a month-long panic where the team was like, wait, somebody else owns this URL. What the hell? We're going to have to go find it. And you happen to see that as somebody in New York and you're like, maybe it was Patrick. I don't know.
No, I knew. He'd actually told me after the first time we met, he goes, by the way, you kept using the term permanent equity. I really like that. I think I'm just going to buy the URL. And I was like, oh, that's cool. Whatever.
Oh, that's too funny. So all right. So perfect segue. You mentioned that, there is obviously a lot of differences between permanent equity and traditional private equity. So let's get into that. How is permanent equity's investment approach different than what most everybody thinks about when they think of private equity?
Yeah. So there's a couple ways to go about this. So one is the size of deal that we look at. So we sit below traditional private equity in size. Especially for platform acquisition. So private equity's got kind of two ways they go about acquiring. One is a platform, which is kind of a new entrant into space, and then they can do bolt-ons underneath that acquisition. For platforms, it's really hard for them to go under $8-10 million a year free cash flow, just based on the 2 and 20 model, the size of the fund, the type of leverage they typically use. It just becomes very problematic for them. So we like to sit in that kind of $3 to $8 million range of earnings, free cash flow, whatever you want to use, what sticks to the owner, right? The deals in that size, they're large enough to where it's hard to pass the hat at the country club and get the deal done. But they're too small for traditional private equity. So there's just nice Goldilocks in between there. And so that's where we focus. Now we've got a couple deals right now that are $10+ million earning companies that we're in discussions with. We will go up market opportunistically. And really what we want to see if we go up market is that the family cares deeply who they sell to and that they're choosing us over an alternative form of capital. And so if you really don't want private equity, and when I say private equity, so it's a typically a fund structure that's got a 10-year life. You got to really buy stuff in the first couple, kind of 2 to 3 years, work on it for kind of 3 to 4 years, and then work on selling it, right? So that's where you get that hold period of kind of 3 to 5 years, 5 being kind of the max. Typically using quite a bit of debt. Traditionally the model in private equity is the leverage buyout model, which is basically however much debt you can get, you backfill with equity. And so you're typically getting both senior debt and mezz debt, and then a tiny, tiny sliver of equity that's going into these deals. You're trying to do typically cost reduction as a pretty major component of the acquisition process, and then you're looking to flip it. And so our model is just completely different in the sense that we're buying with no intention of selling the business. We're typically using no debt in our transactions, which you talk about really freaking out investment bankers. Tell them you're not going to use any debt. We have questions all the time like, did you say use debt? Like, how does that work? Anyway, so we like to keep leadership in place and partner with the leadership for a long time. And really just try to introduce maybe a unusual set of talents and access to resources that these small businesses wouldn't have otherwise, and grow them into larger businesses. And that's what we do. And I mean, we try to treat people really well. We're not cutting benefits. We're trying to grow our way to success as opposed to cutting.
Mm-hmm. So in the most recent interview that you did with, I think it was the most recent one, where it was, I think the headline was analyzed 12,000 businesses and looked at, you guys used every single type of deal structure, or at least analyze ones that work and don't work. I mean, what do you have an experience that really helped? Because you're very much in line with, you have your ways in which you're going about to add a company to the portfolio. Did you have an experience that really guided that experience, that got you to where, okay, this is how we're going to do deals, or does it still evolve depending on the deal that comes through?
Yeah, I mean, I would say we're flexible in how we do deals. We try not to be dogmatic about it. I would say in terms of our style, though, it just evolved out of, I guess, kind of first principles logic. I mean, we didn't come out of so no one who works at Permanent Equity has ever worked at another private equity firm. And I think that's in some ways a positive, in some ways a negative. I mean, the positive is we just don't come from the background of here's the way you do it. Mm-hmm. So for us, how did families get wealthy? They operated a company over a long period of time. They to survive, they didn't take on debt. They didn't try to bite off more than they could chew. They treated people well. They built a strong culture, and they held it indefinitely. Mm-hmm. I mean, I think that's a pretty tried and true way of doing business. I don't know why we wouldn't just follow that and do that. And so I think that's just kind of where we come from, is we just want to operate like a family would operate. And so how does a family operate? Well, it's how Permanent Equity operates.
Cool. So, one follow-up I did have when I was doing my research and looking at your model and the type of company Permanent Equity is. And, look, you're now really well followed. You've done all these interviews and stuff. I mean, can anyone else create and do what you've built at Permanent Equity? Are there any other funds that are similar out there?
I mean, yeah, sure. Other people can do it. I mean, I think so. The ocean of opportunities is enormous. Mm-hmm. I mean, as you go down the sort of pyramid, as you get, I don't know exactly how many I used to be able to remember, but I think there's probably 5 times as many companies out there making $1 million a year as are making $3 million a year.
Right.
And so as you can move up the chain, there's less and less companies that are sort of in that size range. So the bottom of the pyramid is just enormous. I mean, in any mid-sized city, you'll literally have thousands and thousands of companies that are, acquirable on the small end. And so, other people can do it. I mean, it's just really hard. Like, it's not complicated what we do. It's just really difficult. And a lot of it is judgment based. And so, I mean, the only way I think you get better at judgment is by doing stuff and, scraping your face on the pavement and picking yourself back up and learning from it and hopefully not dying in the process. And so, I mean, I think that's, the story that we have is just being intellectually honest about, what our shortcomings are, trying to constantly work on those, constantly learning how to interact and set expectations and how to support the companies. And when adversity strikes, how do you handle it? What resources do you have access to and the experience level? And so, what I would say is that the difficulty, so I wrote a piece, I get a lot of questions about, people come inbound and say, hey, I'd like to do what you do, what advice do you have for me? And so I wrote a piece called How to Acquire Your First Smaller Company. And it really goes through the entire process in that. I mean, it's very abbreviated, but all the things you need to know and all the questions you need to ask. And, it's one of those things that on the surface, it sounds so easy and simple. It's like, I have money, right? Access to capital. How hard can it be? I'll go find a business and I'll do the deal. And it's like, in reality, there's about 400 decisions that have to be made during the sale process. All of them are consequential, and it's difficult to get all the pieces to line up in a way that's sustainable. And oh, by the way, once you get to the finish line, it's really the starting line, right? You close the deal. Okay, great. Now you own the asset. Mm-hmm. Now what do you do with it, right? And a lot of these, as you get on the smaller end, these businesses are pretty lightweight. There's not a lot of redundancy in leadership, and so you just got a lot of different types of risks, and that's why they go for considerably cheaper than upmarket companies. I mean, this is maybe one of the misconceptions that people have, is because of the size of the company is necessarily dictating the sort of average multiple people would pay, and yes, size is a good proxy for heft and complexity. But I would say that the real reason why these companies sell for cheaper is just because they're really risky, difficult businesses to operate post-close. And so, I mean, if you go out and buy an index fund of every small business in the market, you just go to zero. I mean, you just get smoked. Mm-hmm. So it's just it's a very unusual market. I mean, what I love about it is it's highly inefficient, which means you can either make or lose a lot of money, and skill matters. And so I think that's where we're constantly. I mean, we're, gosh, I don't know, 12, 13 years in now, and I still feel like we're maybe 3 out of 10 on the skill level. We've got a long ways to go.
3 out of 10. I mean, on which skills? I mean,
On almost everything. I mean, every single time we do a deal, we learn so much, and it's unbelievable, the accumulation of knowledge. I think that's another thing that makes us unusual is we have a lot of in-house resources. So there's 16 full-time people at Adventures. Look at that. I'm still. It took me over a decade to groove that into my mind. So I've had permanent equity. And really that locks in a lot of the learnings, and due diligence is a big piece of what we do. Mm-hmm. So we're trying to constantly, learn and get better at, how are we sourcing deals? How do we repel the wrong people and attract the right people? When we negotiate a deal, how do we set expectations where the owner maybe has to hear some hard truth, but we also say it in a loving, kind way? And it's really difficult to balance all those things. When you get into due diligence, I mean, we have a 22, 23-page checklist that we customize for every acquisition. You got to answer all those questions. It's brutal. It's really, really hard. There's a lot of nuance, and, you don't want to be cynical, but there's a lot of things that these people don't know even about their own business, and some stuff they do know that they don't want to tell you about, because every business has warts on it. I mean, I guarantee there's skeletons in every closet. And so, it's our job to figure those out and to make sure that we're making a good purchase in terms of understanding what we're buying. So anyway, yeah, I mean, I think in absolute terms, we still got a long ways to go. And then post-close, I mean, businesses are ever changing, ever evolving. How do you acquire customers? How do you service them appropriately? How do you build brand? How do you build systems? How do you, keep compliance in order? I mean, business is hard. Business is really hard. I think maybe for your listeners that are more public investors, if you don't think a business is messy and difficult, you just don't know enough. You're too far removed from it. And I think that's where, all businesses are loosely functioning disasters that happen to make money. Even the largest ones. I mean, what's come out about GE as an example, that was the golden child for decades, right? I mean, they're a loosely functioning disaster. All businesses are. These small businesses are loosely functioning disasters that have a very thin layer of ownership. And I think that's just an added additional risk factor that whether it's public or private. I mean, a lot of the businesses we look at are sort of in the same proxy as the microcap space. And I can tell you, they are messy and difficult.
I was going to say, we have a famous phrase in microcaps is that most of them just have hair. It sounds like it's almost very similar to what you're doing. I mean, I have to ask, I mean, it seems like you'd be stressed a lot, that this is a very stressful thing that you do. I mean, why? Like what got you where you're like, I really want to do this. I'm very passionate about all these different businesses. Is it that you have a curiosity for learning and wanting to understand all these different industries and businesses and thinking and obviously thinking that you can help and provide value, but is that it?
Yeah, I mean, so I would say everything's hard though, right?
Sure.
I would assume public investing's hard. I mean, everyone's got difficulties in their lives. I mean, I think that
getting up in the morning sometimes. I have a newborn, but that's why.
Hey, I've got 5, 3, and 1, so I'm right there with you, brother.
Yeah.
I mean, I think that the tact I've taken is do what you love in a place that you enjoy with people you admire, right? Those are the kind of the 3 criteria that I try to evaluate things by. And, permanent equity is a place where I want to work. It's a place where we can, paint on our own canvas and we can do things that we want to do it. Maybe not the way that everyone else does it, but the way that makes sense to us. And it's hard. There's a lot of bad news constantly. I mean, we have people getting sick, and we have people that unfortunately we've lost in the last year in the companies, and there's always conflicts that will pop up. I mean, again, business is messy, people are messy. It's hard. But I would say if you're not doing something that's challenging, if sort of like your main focus in life is to just accumulate more and more comfort and security, it'll be a pretty shallow existence that you live. And I think that we're called to get in there and mix it up and, try to be a shining light and try to help people flourish. I mean, over time, I mean, that's what our goal is, just to help people flourish. We want the companies to flourish financially, of course, but I think that it starts with people flourishing. And are we doing this perfectly? Absolutely not. We've got a tremendous amount of room for improvement. We're always trying to understand sort of what we can do as an organization to support people better and help us all win together.
Got it. So now I want to dig a little bit into, permanent equities, credo, and your investment criteria. We covered it a little bit, but,
Sure.
I really want to kind of get a full answer there. So, as it states on your website, your investment approach, boring is beautiful. Why does the company believe in this credo? And, I'm going to ask this a little nuance. Would you say it's, obviously, everybody, most of the people who've listened to this have read Peter Lynch and, Warren Buffett and love boring businesses, but do you also, I mean, the types of businesses you're also looking at, these are like classic Midwest blue collar type businesses, they're not some are, but they're not your West Coast, I don't know if you have a cryptocurrency and if you're evaluating one at any time,
but not in cryptocurrency. But our last two acquisitions were in Los Angeles, so in the aerospace business. So we're coast to coast in terms of there's a lot of great businesses everywhere.
What's boring about aerospace? That's freaking cool. I mean, that might just be me.
Yeah, no, I mean, here's the thing: is that boring as a term is so. When properly understood, we like boring because it serves a purpose. It's faithful to its customers. It's not the latest sexy hot thing.
Sure.
Boring in many ways is a huge compliment when we say it, right?
Of course.
And when we say boring in aerospace, I mean the company is Pac Air and AirCert of the two companies out there, and they work to keep planes in the air by certifying parts, finding hard to get parts, and supplying them to their customers. So, I mean, it looks like a warehouse and a lot of different parts, and it looks like people that are trying to serve customers faithfully by getting them the right parts and making sure that the planes can stay in the air. Most people would go into that warehouse and be like, this is pretty boring, right? I mean, you're picking stuff off the shelves, you're putting more stuff off the shelves, you're selling it. For us, we think it's beautiful. And so we just don't want to get involved in things that are the sort of the next hot fad or trend. I mean, crypto is a great example of that. When we were raising our first fund, as funny as this sounds, we had so many investors say, well, why would I put my money, with you all when I can put it into crypto and it just goes up? And I was like, that's a great way to think about it. I would encourage you to invest in crypto. And so, we just want to get involved in things that are what we call kind of main street businesses. And they really run the gamut. I mean, I would say all of our businesses are super sexy to us, but just most people would, if you told them what you did in a bar, they'd probably say, "Oh, that's interesting. You certify airplane parts." Like, cool. All right, moving on. Right.
I feel like that's like every conversation I have with, I'm in LA. Everybody I have, it's a lot of construction and all that stuff. I say I'm in financial news. They're like, financial news. Interesting.
Exactly.
But
you know how it goes.
Yeah. Oh yeah. So, okay. So then let's dive deep really quick. What is permanent equities investment criteria when you're looking for a business to bring onto the portfolio?
So we like to see things that are $3 million plus in what we call owner earnings. So EBITDA minus kind of a CapEx proxy, sort of normalized capital expenditures, any operating interest, normalized owner compensation. So really kind of what sticks to the owner at the end of the day. We have certain industries that we kind of more of a prejudice against. So we're not big into oil and gas. We think restaurants are a really hard business. Healthcare is, highly regulated businesses. We're less interested in those. And over time, again, these may change, right? We may bring on a partner that has deep healthcare, background or something like that and change our profile. But right now, we're willing to look at any industry. We like to find things that are sort of niched into an area of the market that maybe is overlooked. You've got some industries that, like the wine business as an example would be it's a terrible business to invest in when you just like a winery, right? But who makes the corks and who makes the bottles and who makes the wrappers and who makes the shipping containers and who makes the testing equipment for the wine industry and all those things, right? Like there's all these like little interesting niches in all these industries. And so what we like to do is we like to find businesses that are in those little niches, and that we can kind of understand where they're competitively positioned, and that they're durable, and that the customers appreciate them, and want to continue to use them for a long time.
Got it. So my quick follow up to that too is, the firm's now been around 12, 13 years. Has there ever been a fear of you're looking at potential businesses to bring into the portfolio? Now that you've been around for this long, you've done these interviews, you published the book where you literally gave the checklist on how to do this. Has there ever been a fear
Sure.
that, you almost because of all you've ever priced yourself out of a potential purchase, like, that business fit all of our criteria, but their asking price is just a little outside of our range that we would normally do?
Yeah, I mean, I'd say the dominant reason why we turn down a lot of businesses we're interested in is we just can't get to price and terms, right? I mean, and it, sort of unlike the public markets, price is just one of our levers. I mean, the terms almost matter more than the price. But yeah, I mean, this is very common. I mean, people, everyone thinks their house is worth more than it really is, right? The endowment effect is rampant everywhere. And so this is something that you've built for 20, 30, 50 years. You're going to think it's worth a ton. You're going to know all the risks, and you're going to be comfortable with all the risks. And any buyer is going to look at those risks and say, no, wait a minute, I don't know, right? I would say our biggest competitor is somebody not selling. So it's not somebody else coming in and buying it, especially the companies that we really like to work with that care deeply who buys the business. I mean, we've got two of these right now that we've been in discussions with, one for 2 years and one for 4 or 5 years. And, it's about every 6 months we dance with them, and, they get cold feet and we back away. And it's not like anybody else is coming in to buy those companies. It's just a matter of, the family saying, hey, we want to kind of keep it the way it is. And it's really hard. I mean, these businesses make a lot of money, and, if you're always going to make more money not selling your business and keeping operating it. So it's just, at a certain point, though, the business goes into secular decline. You have a health issue, hits a hiccup, and you're not there to be able to support it. And it usually, unfortunately, that's how a lot of businesses go under.
Gotcha. So as I said at the beginning of this interview, I recently saw the interview that you did live with Morgan Housel at the MicroCap Leadership Summit. And there was a couple quotes that you said that I wanted for you to elaborate on that I really, they stuck with me. And
sure. I say a lot of dumb stuff, so hopefully they're not those things, but yeah.
Well, you know what? I have a lower IQ anyway, so, maybe we'll see. So this first one that you said is, and this actually has to do with something that you said earlier and wanted you to elaborate on, is you said, don't cost cut as value creation mechanism. Underspending sometimes can be the case. Sometimes you want to help them, being the companies that you want to bring in the portfolio, realize that spending $1 can result in $3 more down the road rather than $1 less in their pocket. So I that really stuck with me, and I really loved when you said that. So can you elaborate a little bit more on it?
Yeah, I would say so. So if you think about the small business mindset, there's no agency problem, right, with small business owners. I mean, they're operating the business, they own the business. So literally every dollar they spend is $1 less in their pocket, right? And they feel it that way. And so when it comes to things like marketing, sales, investments in technology, they have a tough time making those investments that would certainly pay dividends. But one, they don't have the skill set to do it. Two, they've never seen it done before. And three, there's a lot of just fat and happy syndrome that goes on. And so we'll oftentimes come to these businesses and say, now, wait a minute, if we did this, here's the return on invested capital, here's the payback period, all these different things, ways you can show sort of what the return would be. And they say, yeah, that's okay. Mm-hmm. And, we were like, why, right? And the answer is always a little bit different, but ultimately it's some combination of don't know, don't care, or just a fundamental lack of, I think this is maybe symptomatic of a lot of larger issue, which is the talent pool of these smaller companies is fairly limited. Mm-hmm. And so, a lot of the consultants that work in these industries, in these size of companies, I should say, are just not good at what they do. I don't know how else to say it. And so if you're a marketing person, right, you marketing consultancy or advertising consultancy, you're going to work with a local plumbing firm versus you're going to work with Coca-Cola, right? What type of talent are you going to be attracted to, right? So basically, the only people who continue to work with sort of local small businesses are people who don't know what they're doing by definition. Or if they did know what they were doing, they would be able to acquire larger and larger customers and do better and better for themselves. And so, we will oftentimes have people come in and say, well, marketing doesn't work. And it's like, well, yeah, actually, you're right. For who you know and the resources you have access to, marketing doesn't work. Now, I can tell you that marketing as a principle does work, and advertising, you can get a return on your investment. And it's a great way to build a moat around a business. It's a great way to build a business. But you have to have access to the talent. You have to know what you're doing. And unfortunately, those people are just not the people who are going to rise to the top of the consultancy pool and for small businesses, as well as the people inside the companies.
Gotcha. All right. So the other quote that you said there that I would love to, kind of get the difference between is that, you talked about the difference between hustles and businesses. So can you?
Yeah.
I know I actually think you talked about this on another podcast, but I'd love to get your thoughts again.
Yeah.
Really the big difference there.
Yeah, so we use this terminology internally. A hustle is a business that, and by the way, these things can be big. We saw a $15 million hustle recently. This is two brothers making $15 million a year. So like these guys are killing it. These hustles get very big, but if you pull them out, the whole business collapses, right? And all of the equity value of the business is tied up in their relationships and their expertise. And it's just, they're the linchpin of everything. And so, a hustle is unsustainable. It's sort of a temporary thing, versus a business is sustainable. You've got decision-making that's been pushed down in the organization. You've got a diversity of relationships. You have systems and processes that can build repeatable value in the firm. So look, there's a fine line sometimes between a business and a hustle. And I think that you can, obviously, all businesses started off as hustles and then made a transition. So we're kind of towing that line sometimes, but we like to buy businesses and not hustles.
Gotcha. And, by the way, I was just thinking back to an earlier question. I wanted to make sure it was clear that there was no implication that the Midwest or Missouri, anything about that is boring. Okay, it is an amazing place. I can't wait to visit. And again, congratulations on the Kansas City Chiefs winning. So that was a big deal.
That was a huge deal.
Yeah. So this is a question that I really wanted to ask you. Being a family man, you got 3 kids, and just all the work that goes into what you do at Permanent Equity. What would you say is the most difficult part of your job?
It's always going to be people related, right? It's always going to be the conflicts that just naturally come up. We all think we're way more important than we are, me included. We all think that we contribute more to success and have less to do with failure than we really do. Just the whole world and the way we're designed, we're just set up for conflict, right? And so I would say is having to get involved in situations where there's a lot of bad behavior sometimes. A portfolio the size we are and all the people that are involved, there's just going to be unfortunate situations that pop up, and trying to be wise and thoughtful and loving in tough circumstances is something that I try to do, fail often at, and have to apologize frequently for. But I think that the hardest part of my job is just seeing people that have made bad decisions or just had some unfortunate consequences of circumstances that have come up. And, how do you muddle through it? And just some stuff just is hard. And a lot of stuff's just really hard. And, trying to do it with a little bit of grace. But it's always going to be people. Always.
Yeah. Oh, yeah. So what would you then say to investors who focus on investing in public companies? What can they really learn from your investing approach?
Boy, I don't know if they can learn a lot. Unfortunately, this may be the dead end of our of our podcast here, but I think many of the principles are similar in terms of how you select. You're looking for things that have a sort of durable competitive advantage. You're trying to buy them at a price where you feel like that there's upside with it. I think the microcap space is probably the last frontier of the public markets that you can actually generate real sustainable alpha over time. I think it's really, really challenging. I mean, I know a lot of people to play up market from you all, and it's crazy how many smart, highly technologically advanced and incredible competitors there are, right? I think in the microcap space, you're protected a little bit for the same reasons we're protected, right? I mean, we chose our segment of that $3 to $8 million range for a reason. And I think it's because, we've got a sort of a Goldilocks protection in that segment. So I would say, it's smart as long as you've got sort of the curse of success, but as long as you've got a little enough amount of capital where you can play successfully in the microcap space, which is still, I mean, for an individual is a heck of a lot of money. Mm-hmm. If you want to try to raise capital and build a business, it's more difficult, but I think there's plenty of good hunting in that area. I mean, I think there's going to be a challenge in the future of what companies go public and stay public. I think you have a lot of the smaller microcaps or sort of legacy businesses that have been around for a long time. And I don't know many people who want to take something public these days. So, it's just, I'm hoping that regulation changes and that there's more freedom and just making it more attractive to take things public. I think there's a lot of returns that are being, if you're not playing in the private markets these days, I think you're leaving a lot of returns on the table, and it's very high barrier to entry. It's very difficult to get involved in. So, I mean, I would say what lessons can be ported over is just, doing the hard work and really analyzing the companies, making sure that you don't take somebody's word for it, doing your own primary research. I mean, these are all the things that we do in due diligence in the back of the book. The messy marketplace. I mean, we have that checklist. I think that checklist is a pretty good checklist for the public markets. I know a few guys who've used it that way. And I mean, a lot of those questions you probably can't answer, which is probably a good indication of how well do you know the business. The more that you can spend time with the leadership of these companies, I mean, I don't know, it depends on the size and style of the investors, but I think it's really important to spend time with people and to understand sort of what makes them tick, what motivates them. I don't know.
Gotcha. Well, it's okay. I won't have a follow up to that one, even though, it wasn't dead. There's more there for sure. But I asked you this question about what's the most difficult part of the business. I don't want to be a downer. What's the most fun part of the business too?
Oh yeah. I mean, it's also the people, getting to meet the people. And I mean, it's the best and worst. We get to meet, look, I live a charmed and it's a gift, the life I lead. Getting to fly around the country, meet people who are passionate about all different kinds of business, who on average just love their families, love their communities. Just we get to interact with some really great people, and so ultimately that's I'd say that's the basis too.
Cool. So this is a question that's my favorite question to ask everybody that I have on, and you've touched on this a little bit already, but what investing experience would you say has impacted your career the most?
Investing experience. I would say having a lot of failures has probably been the most instructive. I mean, operating companies is so much more difficult than it appears. And to be an investor without that experience, I just don't know how you do it. I mean, I think your your intent would be all off in terms of what you think's hard is actually not that hard, and what you think is easy is brutally difficult. And so I'm just really grateful that I had the experiences of running companies myself and being in an operating role and having to make payroll and feeling the pressures of customers bearing down on you and employee issues, and just understanding how complex and challenging day-to-day life is as an operator. Certainly has made me a far better investor and far more relatable to what we do. If I pick stocks for a living, I just don't think I'd have the empathy and the experience to understand sort of what's really going on in the trenches.
Gotcha. So then, as we close out the interview here, I want to know what advice would you have for either new investors, either I guess in general, looking at public markets or even wanting to start up something like what you got at Permanent Equity?
Yeah, I would say take it slow. So one of the things I think that is the most dangerous is sort of newcomer syndrome of feeling like you're an expert after a couple months of doing something, or even a couple of years. I mean, look, we toiled away in obscurity for the better part of a decade and got our ass kicked repeatedly. in all kinds of ways. And through that, we were able to hone, and it's not like we're perfect now. We're still learning a ton on an ongoing basis. But I can't even imagine what would things have looked like if we had access to a bunch of capital when we were first getting going. There's some people that I know that are raising vehicles right now that are going to try to put to work a bunch of money, and they've never done it before. They're probably smarter than I am, and they'll probably be fine. I just would have gotten smoked. So I would say if you're a public investor, just take it slow. You don't need to get rich fast. Be sustainable, learn. And I think that pride before the fall. As soon as you feel like that you really know what you're talking about, you're probably on the precipice of a pretty big disaster. So stay humble.
Gotcha. All right. Well, with that, Brent, where can my audience go and find more information about you and Permanent Equity?
Yep. Yeah, so the website is just permanentequity.com. I'm probably the most available on Twitter. I try to check Twitter, 3 or 4 times a day. My DMs are open. I'm at Brent Beshore on Twitter. And, you got to put up with some bad private equity memes and dad jokes. And I guess I should note that my highest achieving tweet of all time is a Taylor Swift joke I made last night. So I got that going for me.
All right, what was it?
Swifties now that are followers.
We got to hear it. What was it?
Some people were putting like the 7 albums that me by, and I put the 7 Taylor Swift albums. That would be how you'd know me. And now I've got a worldwide following of Swifties now that are they're going to be up for a very rude awakening when they realize that it's bad private equity memes and dad jokes is what they've got in their future. So,
well, you know what? They're just hoping that eventually there's going to be another Taylor Swift joke and or meme eventually.
I'll lace one in there somehow. So anyway, hey, I really appreciate the interview. It's been fun.
Brent, thank you very much. I really appreciate you taking the time, and I know you're busy, so thank you again.
Have a great day. Thanks.
You too.
Bye.
Bye.